Good evening, partners, and wishing you all a happy new year 2022. So today we have an interesting session on this new year with Mr. Shreyash Devalkar. So before going
Good
to the
evening,
session,
partners, and wishing you all a happy new year 2022. So today we have an interesting session on this new year with Mr. Shreyash Devalkar. So before going to the and wishing you all a happy new year 2022. So today we have an interesting session on this Mr. Shreyash Devalkar. So before going
there is some echo which is coming. Just a moment. Sorry, partners, there has been some technical issue which has happened. So, good evening to all. Today we have an interesting session with Mr. Shreyash Devalkar, who is a senior fund manager at Axis Mutual Funds. He had joined Axis Mutual Fund during 2016. He handles the funds like Axis Blue Chip Fund, Axis Mid Cap Fund, and Axis Flexi Cap Fund. And he is a most trending person in the YouTube and in the social media, and he is a well-presented fund manager with Axis Mutual Funds. In this call, it's a live streaming session which we are doing in the YouTube also. So if there are any questions, please put your questions in the YouTube live comments. At the end of the session, I'll be moderating this call today, and I'll be asking the questions at the end of the market outlook presented by Mr. Shreyas. And over to you, Mr. Shreyas.
Thank you. Happy New Year to all of you. Generally, just to start with on the outlook, but always it is good to know the context in which we are looking at the outlook, and the context to set with a better way to look at what happened, and whether we should say that the same thing will repeat or it will be there will be some changes. And so for that we need to look at what happened. And if you look at what happened, especially post COVID crisis, almost 1.5 year, almost now 2 years ago, I think from March, it will be 2 years now. In the recovery, what we saw in the economy post initial shock of pandemic, what happened was we saw the strong stock market, but it was also back, and there was a real misery for humankind. And in that context, there was a divergence, or I think the often used word nowadays is the K-shaped recovery. So there was an increase in wealth of the wealthy, but there was also increase in number of global poor. Actually, these phenomena is also getting reflected in many high frequency indicators. So if you take in US, they should start with, you must have heard that yes, in US there is a good demand for housing, but the fact of the matter is the houses which are costing more than 7.5 lakh a dollar are actually there the number of units sold are higher than pre-COVID level, while the houses which are cheaper, their number of units sold are lower than pre-COVID level. In India, we don't get such a data, but if you use proxy, then what you would observe is overall registration data, what we see versus what we see as a earnings or the sales figure which are reported by the listed real estate companies. So listed real estate companies are normally they operate at a higher price points, and that's where we have seen growth, while a lower price point has not. You take the data point like two-wheeler sales. The two-wheeler sales again shows similar kind of trend. The two-wheeler sales has not improved. The two-wheeler is the mode of transport which is used by the middle class or lower middle class for the transportation. And on the other hand, the sale of SUVs or the cars more than 8-10 lakh, there would be jump. So net that divergence is observed this time. And normally what happens is whenever there is a shock, that shock can be in the form of anything. It can be in the form of financial crisis. It can be in the form of some financial companies facing trouble, which happened in India earlier as well. During such shocks, which and also it happened during pandemic. During such shocks, this kind of K-shaped recovery happens, and that was observed. But then in all these, the hope was on the vaccine, and but the despair was in the form of new variant. I think now there are various views around it, and at least if you just extrapolate what has happened in the Western world, including and also in Africa, the point is this a number of cases increased everywhere, while those who started early, they have seen peak and probably it is coming down. And there are various talks or various experts are suggesting that it may be last of the coin, but I hope it is true. But net that has created again a certain shock for the humankind, and again that story of the K-shape, because of which the widening of the gap that generally continues. I hope this wave which is there now, it is short-lived because it is too fast. So I hope that it doesn't last longer the way it lasted longer last time around. And already all of us are witnessing that it is not as severe so far as the earlier waves has been. So that is again a silver lining in all this thing. So in these, what economic policies happened during the last 1.5 years, where about increase in the fiscal spend as well as monetary support, and this has helped global reflation. It has helped the flow of the funds to various market, both through so when the Western world, because of its immense, and especially US in this case, when they spend, then the exports of the China's and India's of the world and Vietnam of the world increase, and that's how we get money. And also they invest somewhere, and that money also flows to us. So both these things has definitely helped us in last 1.5 years. What it transpired into the market was the Indian market delivered around 24% return in last year, and but actually we have done extremely well. So MSCI EM index, emerging market, that actually declined by 5%, and global indices also delivered 20% return, especially in the US, again led by the US market. In India, again, what we observed was the large caps underperform, and mid cap and small caps did well. In which capital goods, IT, real estate, metals, these are the sectors which did well. What is the underlying theme behind this, and why this happened? Again, we need to know the reasons to draw some conclusions on the future. The reasons were that before COVID, generally, you must have observed that the consumer sector or the India consumption story outperforms the investment stories. But during pandemic, obviously, because of the movement restrictions, the consumption story could not have done well. And that is where these other parts like capital goods, IT, commodities, they did well during this time. And again, they were also helped by multiple bottom-up parameters in each particular sector, which we can discuss later on when we discuss about the sector. But point is that this shift which happened was more also the outcome was of the consumption sector, the key sector has not done well, and that is where the reason why the retail credit growth didn't do well and the financials underperformed during this time. Now coming to 2022 and what we are staring at now, and so the starting point for the market is like we are staring at the rich valuations for the market, for the sector stocks. So whatever story is there behind each particular stock, and most of them has been in B2B space. So it can be a chemical industry, it can be IT industry, it can be industrial stuff, or consumer durable, or consumables which are being used by industries. So in this sense, this section of the market is definitely at really higher valuations. And the factor which helped was the resilience which was shown by individual industries and the margin improvement. And that margin improvement has played a substantial role, especially in CY21, or whatever happened in the individual stocks, because the earning upgrades were led more by the margin improvement during this time. In this year, because of this, what we could expect is, if it's very difficult to take a call on a sectoral basis. The only and since especially the pandemic is adding uncertainty to the overall markets and overall economy. And that's where this shift, which I described earlier, there was a shift, definite shift to the so-called B2B segments, helped by the tailwinds in the individual segment. It's not that it's just because of the market wanted to move away from consumers, but that shift which happened. And normally what will happen is after every wave, actually that gap started increasing. And so if this cycle, the way or if this wave, third wave, which some of the experts actually at least are predicting to be hopefully the last wave. If that is the case, then there may be a chance of reversal to the consumption stories, and they outperforming the B2B stories. So that is a chance. But then, because again, as I said, that these waves, which all of this started, no one expected that it will last for long. At a point in time, we thought that with vaccination the thing will happen, but then we are here again staring at some sort of movement restrictions, the way it is happening. So it will have definitely impact on the internals of the market, and that is most important parameter which we should remember here, that the internal changes, that is shifting from B2B to B2C or B2C to B2B, that would be dictated by the pandemic situation during this year. So apart from that, well, if we look at India as a country and our situation, especially on the macroeconomic front, there are multiple things which has gone in our favor. So first of all, we have done extremely well on the fiscal deficit side compared to the world. So it's not that absolutely our fiscal deficit obviously had to increase because of the pandemic situation, but compared to the world, we could have managed with the lesser dent compared to the others. Second, but it had its flip side, obviously, that in the recovery, it could not have helped. But because the Western world spent, and actually we have a very good export industry as well, that industry definitely benefited because it was spent by the Western world during this time. So on the macroeconomic front, the fiscal deficit is good, our current account deficit is good, and more importantly, if there are some imbalances, the FDI, FII in both equity, and especially FDI at these times, that everything has been good. So this has supported our current balances. As far as inflation is concerned, inflation this time has been tricky. Normally the inflation happens across categories because of demand and what we call the demand-led inflation. this time around, there was an element of supply constraint. And that supply constraint was not just outcome of a pandemic. It was also outcome of the geopolitical issues. And so both pandemic as well as geopolitical issues, both of this has resulted into the bigger supply constraint, and that had led to inflation. In our opinion, this year, we with the base already being formed, the inflation may not be the worry once we will be towards the end of the year. Hopefully, and again, it depends on the waves also. But hopefully, the inflation should not be the worry by the time we end the year. And that's where the most important or the elephant in the room, especially as far as equity is concerned, everyone talk about tapering and all. So if that is not going to be the case, then the interest rate increase, obviously it will increase initially. But then if the inflation comes down towards the end, then that should be a less important issue as such by the end of the year. And that is where it is important to know that why that inflation has happened and whether it is sustainable. And most of the reasons, especially in individual commodities, as we said, that it is more demand led and it can be reversed. Wherever it is geopolitical led, probably it is not going to reverse so immediately. And that's where that segment by segment call one need to take, and accordingly, what we try to do is try to identify the winners and losers during this during this time. So this is broadly on the macro front what we see. The questions can be around what happens because of tapering and what is the impact. Actually, already the other question is around the COVID. But then the answer to COVID is already because of the earlier two waves. As I said, that the pattern and the reaction by the market is already known. As I said, there is a shift from B2C to B2B, and that story continues. If there is repeated waves, if there are no repeated waves, and if it ends, then it would not. Then the intervals would change to B2C. That's how it would India specific B2C. That's how it should pan out. As far as tapering is concerned, tapering had multiple impact. One is initially, as you know, that tapering means lesser flow of liquidity, and because of that, the valuation compression. So the expensive stocks correct, and that's what generally is has happened earlier. But eventually, after this correction, eventually market has taken a path of growth in individual stocks. So irrespective of the valuation, actually the stocks which are growing the fastest had outperformed end of the day. That has been the case during 2018 tapering. That has been the case during 2012-13. So always we have seen that during the correction, the market follows that valuation pattern. But end of the day, over a period of 1 or 2 years, the growth that matters, whoever delivers growth, generally those stocks end up outperforming irrespective of valuation. And obviously, in this case, there are certain segments where there can be a so-called bubble, especially in the companies where there is no profitability. There one need to take a definitely a more closer view, in a sense, how would shape it up there, because in those cases, at least in India, we don't have a historical judgment to be used, because most of these companies are listed recently. If you take a cue from Western world, then there has been correction, which we have not seen in India. But then again, in India, as I said, it's a new phenomenon for us. But one should always look at those companies more closely, and one should be more cautious on such segments where the profitability is there, because any valuation can be justified for that space. So this is where the tapering impact would pan out during this year. Uh, if I now want to just I highlighted on the macro front, I highlighted on the both pressing issues which are COVID as well as um, pandemic and tapering. So in these two cases, this is how the market should play out, and taking a call on whether this is the last wave or not is really difficult one for anyone. So now, lastly, I'll just touch upon the sectoral view and probably the large mid versus mid. That is what also is of everyone's interest. Uh, to begin with, taking only sectoral view. In that, the largest sector obviously is the financial services or lenders, you can say. In the lender space, there has been concern over fintechs. There has been concern over weak credit growth, and this credit growth is expected to be weak, especially on the corporate side. So there, our view is the corporate credit growth may not be high, while in India, but it is not. It is nothing new. It is not the new news. The point is, it has been slow even pre-pandemic. Since 2016-17, actually, corporate credit growth has been in mid single digit, and actually it went to low single digit also. So corporate credit growth is expected to be weak. India has been story around retail credit growth. Retail credit growth has been around 13 to 15% CAGR over 5 to 10 year basis, and that is the piece where one should focus on. And in our opinion, that is where the money can be made. There are many fintechs which are coming in, but still one need to be very choosy in that and be with the NBFCs or banks wherever one can think that they can outperform and they can outsmart probably the fintech world as well, or cooperate or collaborate with them for betterment or the better future for both of them. So this is about the financial services. Financial services. After that, the biggest sector obviously is the IT services. In IT services, we have seen definitely change in the growth trajectory for the IT services post-pandemic. Individually, across the stocks, uh, various experts expect that this will continue for some time because of various trend change, adoption of digital, individually in individual category sectors like autos, going for automation to EV. Individually, if you take the end user industry, including financial services, there are multiple changes happening in the end user industries as far as digitization is concerned, cloud is concerned, and the Indian IT is serving them. So that should continue to do well. Valuations are high, definitely. But again, as I said, the problem of this year is the valuation are high everywhere or anywhere. You see a good outlook, at least in the near term. So that would remain, in my opinion. Then thirdly, then there are other sectors like consumption, which is the largest sector. In consumption sector, again, the observation is at least so far, the revenue growth number has not been great, especially on the FMCG side. What we are trying to look at is the 2 year CAGR growth numbers, because on a low base in any company, 1 year growth can look good. But any company which can show the 2 year CAGR growth or much higher, then that is really the thing one need to watch out for or look for the investment. So in this case, actually, FMCG industry has not shown it, while the retail industry has shown that character in whichever companies who would have opened more stores during pandemic, and then they are now benefiting from both inflation as well as opening of new stores. So in the consumption space, the observation has been the retail has done better than FMCG. Or on the other hand, whoever is dependent, again goes back to the basic thing that which we started with, that there is a K-shaped recovery. So in the FMCG, the rural dependent companies did not do well, while those who are urban dependent. That's why you say that jewelry sales by the largest jewelry player is good, which while at the same time the FMCG sales of the largest FMCG player is not that great, or the growth there is not great. And again, this is adds to the one more proxy to it. So in our opinion, the retail has done well, or will continue to do well compared to the FMCG per se. After that, then we have sectors like auto. Auto again, like banking, there is overhang of EV as such trend, and there is a at the same time here, as I read again in the opening remark, that two-wheeler trend is not good. Even four-wheeler, there is a divergence in various categories. The higher categories are getting sold. So apart from just EV as a disruptive trend, the underlying growth also has not been great. So one need to watch out for that growth, whether it bounces back, and that's where I think that would be the key element to be watched out in autos for this year. Because the good thing is at least the commodity prices are coming down, so it should provide some tailwind for margins. But if it is also helped by the growth in the underlying segment, then that should be the good news for the sector. So that is about auto. So these are actually the key sectors in the economy. So I think that's the broader views we are having across sector. And again, now lastly, just to comment on the large versus mid versus small cap as a category. One need to remember that in the large cap, which is Nifty as an index, the financial services is the highest exposure, almost 35% plus. Financial services having underperformed the broader market has been one of the reasons for large caps underperforming mid cap and small cap, because mid cap indices are having lesser, around 20% exposure is to the financial, while large cap is having around 35% exposure. Apart from that, mostly the large cap companies are in the penetrated categories like FMCG industry. In case of retail credit growth, you are dependent on the retail credit growth of India. So in the large cap, there are more such companies which are dependent on the only IT has been the actually one can say is the large export sector in the large cap. But most of the companies are dependent on the B2C element, and being penetrated, they depend on the holistic revival of the economy, and that has been one of the reasons for their underperformance. That holistic revival was not the case. While on the other hand, in case of mid cap, there are individual stories like chemical sector or durable industry, as well as mid cap IT and so on. And actually, some of the industrial companies are also there in the mid cap segment and small cap segment. So these companies, so this is because more, as I'm highlighting that it is more of a representation what it lies where, and that has been the reason for this divergence in last 1.5 years. What has happened? Going ahead, again, to put that caveat of if and only if this is going to be the last wave, then probably, in my opinion, the large caps may not underperform. I'm not saying they will outperform, but they will not underperform at least. If there is a broad-based recovery in the India GDP and the economy of India, then large cap may not underperform the way it has so far. So this is how it should pan out in this year. So I think with this we can take questions.
Hi, Shreyash. Very well presented on the macro and micro sector and market cap wise. So we have some interesting questions today with us. So the first question goes with Mr. Samson. He is asking about the current market cap to GDP ratio is somewhere around 116, which appears to be an historically a higher valuation on a market cap to GDP. So how do you see that with current levels?
See the ratios for the market cap, whatever denominator you use for the market cap, you can use GDP, you can use earnings, you can use EBITDA on any metric. The market is expensive. There is no two way of saying that. So one should not argue on the valuation. So that's why I said that we are starting the year with high valuations. Normally, what happens when you are sitting on the high valuation? The success rate in the market comes down. It's not so at the lower valuations, normally out of 100, 70% companies will do it. So the probability of winning is 70%. When the valuations are high, the probability of winning comes down. And then what we observed during 18, especially and 19, that the fewer companies start giving you the returns compared to the overall market. So the market and that is one of the reasons why the overall return on the portfolio comes back to the nominal GDP growth. So nominal GDP growth in India has been around 8-10% or 10-12% in that range, and that has been the returns over longer period of time. So and these are the precise reasons for that. So one should, when we are on the back of it, one should expect definitely the moderation in return. One should not extrapolate 1.5 what happened in last 1.5 year. So the moderation of the in returns is the outcome of this.
Great. So we have a next question from Mr. Ravi Kataria. He is asking about how will banks perform in 2022 considering the present scenario.
So as I said, banks are facing two challenges as far as the valuations and the stock market performance is concerned. One and more important is the credit growth, and second, the fear of disruption by fintech. I'm not saying reality, how much reality is a different story altogether, but the fear of disruption by the fintech. So to address the first question, that's why I highlighted that in case of India, the retail credit growth has been story always. Again, because of the disruptions by pandemic, the retail credit growth cannot happen, could not have happened in last 1.5 years. And that's where even the retail credit growth didn't do well. And that is one of the reasons why the bank's growth could not have been as good. If hopefully, if this wave turns out to be the last one, then one can expect the retail credit growth coming back to its glory. Corporate credit growth, I don't see much revival. And that's where I would be more positive on retail credit growth driven stories in the eventuality of this turning out to be a last wave. So that's how it should pan out. On the other hand, there is the element which is draggy, creating a drag on the valuations, especially is the fintech, because the fear is the fintech will take away or try to reduce the fee-based income of the banks, as well as they would also compete at various niches where there is a high profitability. So in these cases, one need to really take that bank specific view or NBFC specific view, whether those individually are trying to do something around it, either through collaboration or independently themselves. And that's how it should pan out in case of bank and NBFC. So overall, probably one cannot expect the broad-based returns because of both these two reasons. Corporate versus retail, the retail should do well, and secondly, the bank and NBFC who can show that they are digital ready, they can do better than the others. So that's where it will narrow down.
Thanks, Shreyash. So we have one more interesting question that since the pre-pandemic levels from 1st Jan 2020, IT is the key outperformer with 55% plus kind of CAGR, and followed by industrials, healthcare, metals, and consumer durables. So, how do you see the sector performance happening in the coming months?
So that's what actually I highlighted in my opening remark, that yes, these sectors outperform. Underlying reason has been shift away from B2C to B2B, because B2C could not have done well during pandemic. So the pandemic outlook would have first bearing on this shift back to the B2C from these B2B segments. So IT is also B2B, everything is B2B. Now, second opinion is on the individual sector, on the bottom of it. So it is, I'm not saying that without any sector tailwind this happened. So individual sectors had their tailwind, out of which I think the way inflation should pan out, probably commodity may not do well as such, because the inflation, at least we expect to come down during this year. Apart from that, industrials, I don't think the growth trajectory has changed much for them. And the valuations there also are at almost high. So I also don't expect them to do really well. IT will depend on the IT. The good part of IT is the free cash flow generation is very good in this sector. So as long as the demand is good, I think that sector should do good if the demand continues to remain the way it is they have delivered so far. There also valuations are high, so the expectations in some of them are probably high teens growth. There can be some disappointments, but all in all, they should do okay. Obviously, as I said, at the high valuation, one can't expect extrapolation of previous returns. The returns will definitely come down in these segments. But these are the factors which will determine, and unfortunately, pandemic being one of them, it is very difficult to give a definitive call on whether it will or it will not.
Thank you, Shreyash. So we have the next question from Kadir. So he is interested to know that over the last 3 months, we saw the market crash by more than 10%. Most of us highlighted Omicron, FIS selling inflation fed for the cause of the same. Trying to link this with 10 to 30, 40 years, largest bond issuance from India. So he is basically wanting to understand what can be the next triggers for the market correction from here on.
The biggest trigger would be, in my opinion, and which is always actually. So all these are frankly end of the day means on a 2-year, 3-year basis I'm talking about, and not in a 1-year basis. On a 2-year, 3-year basis, this remains end up being a noise. So that you are, why I'm saying that that you observed during 2018 also. So 2016 post demon there was a crash or fall, you cannot call it crash, but there was a fall. 2017 on those bases took extremely well, the sequential recovery and all, and the market went to new levels. But 2018-19, the earnings were not there and everything normalized. It took time, but it took 2 years for it to normalize, but then it normalized. And that is the phase which is devoid of any excitement, and it is only backed by the earnings. So exactly 18-19 was that period, that no news flows you want only earnings, and especially at the high valuation that happens. So now also similar thing will happen, that once this I hope again everyone hopes and prays that this is being a last turn out to be a last wave, and then life goes back, and now after that what happens to earning. So there was a certain trajectory with which every sector was growing pre-pandemic. Now post that, whether there is a change in trajectory, if there is no change in trajectory, then the excesses will start correcting. If there is change in trajectory, or in whichever sector that trajectory remains, there you can see some returns. So the net the individual companies returns would be depending on the earning growth, whether they can show that the change in trajectory for their revenue growth or not, or volume growth or not, more importantly. Because see, because of the inflation also, some things are looking good as far as volume revenue growth is concerned. Important again is the volume growth, because that's the real crux of it.
So we have the next question that from the first time investors, can we recommend hybrid or BAF kind of and products to get a better investor experience at the related to the current market levels?
See, always these decisions, as you must have read by various experts, are dependent on the individual's risk-taking ability, his current asset allocation, and his age profile, and all those things. So, frankly, the decisions are should be taken based on those things. In which you have an option, either you take a BAF as a product and put entire. So, if you have 100 rupee kitty or entire asset is 100, then out of that, if you want to allocate 20 or 50% in equity and the rest in a debt, then you can choose either a BAF as a product, or the same you can achieve by investing 20-50% in the directly in the equity in whichever funds you like, and rest in the debt funds whatever you like. So the outcome is same. So that's how I look at it. In these choices, that whether you what you want to do exactly, whether you want to do this way, that some people choose to select equity funds separately and debt funds separately. Some people choose to select one hybrid fund and then sit on it. It depends on the individual investor, his maturity in the market, his ability to understand, and someone to explain them. So that's how it should be.
Interesting. So we have another question from Davani Pro. So he's asking basically which sector are you going underweight in coming years? So already you have been answering a lot of questions based on the sector in your presentation. So would you like to take this question also?
At least individually sector wise, if you notice, then probably we are already, means if you notice our portfolios, then in our portfolios we are underweight on autos as such, and yeah, actually not and oil and gas maybe. These are the two sectors, and commodities. So these are the couple of sectors where we are underweight. But the outlook based on how the things pan out in individual sectors, one may change on this, but this is how, as of the large portfolio, it looks like.
Great. So one more question from Jayesh Bhatt. Do you think that government will allow MFs to invest in crypto in next budget?
Sorry, you are asking me whether they are.
Yeah, whether the crypto can be invested through MF.
I have not heard, and I'm not really privy to such information.
Okay. So we have the next question from Gibi George. So under this uncertain times, which are the funds of access one should focus on?
Under this uncertain, which of the fund?
Yeah, basically he's trying to understand which are the funds that we can recommend at current levels to the clients in equity.
Frankly, that's one of the in my answer I tried to answer on the last. See, the funds how they classify. One but is hybrid, and that's where I told my view that whether you select which funds to choose, and whether you select large, you want a portfolio of large, mid, small, and debt separately, you can do it that way. If you are choosing your debt equity portion, and in that, then it is about large, mid versus small. At least outlook wise, in my opinion, mid small is expensive, large is more India macro driven, and that's where India it has had overhang. If again this wave turn out to be the last one, then large can do well. So in that sense, it can do well. I'm not saying they will outperform, but then in that sense, I would be frankly neutral on the on the segments by large, mid, or small. So large mix of large and mid would be the good one.
Thank you, Mr. Shreyas. It was a nice, bright, and interesting session that we had with you on the market outlook. So we thanks a lot for your time, and thanking you all the Asset Plus partners for joining us this session. And a small information is that we have made lots of marketing collaterals and SAP creatives in this dashboard of Asset Plus. So please go and download those marketing collaterals. With that, our High Achievers Club, which is the privilege club for all the Asset Plus partners, is ending by March. Please do have a focus on the High Achievers Club also. So thanking you all the partners once again, and Mr. Shreyas for giving us this wonderful session today. Thank you all.